Business Plan webinar. My name is Dr. Robert Garios, a specialist in the area of business consulting and digital marketing. This webinar is offered by the Continuing and Professional Education Directorate of the University of Doha for Science and Technology. Here is an overview of the topics that will be covered during this webinar. So as you see, there are 6 main topics: nature and purpose of a business plan, the business idea and its legal form, how shall we do a market assessment and how to prepare the market mix plan. Fourth, we have to cover all that relates to operational planning and sales forecasting. Fifth, it is essential in any business plan to have some financial results. What are the financial results in terms of profitability, in terms of liquidity, in terms of leverage, etc. And finally, we conclude the webinar reflecting on the importance of doing a performance measurement. And definitely there are many risk drivers, there are risk factors. It's very important for the entrepreneur from the beginning to be aware of the risk factors and what is the strategy for risk mitigation and risk management. Now, in general, this course shall introduce you to the framework of preparing and presenting a business plan. You will learn the nature and purpose of a business plan as a roadmap for attracting capital. You will cover market development and managerial success. So you will also be informed about the whole process and the steps you need to follow from the beginning, which is idea generation, next to planning. And by planning, I'm talking about the marketing plan, I'm talking about the financial plan, I'm talking also about the operational plan. Then such plans have to be implemented in the field, in the marketplace. And during the implementation process, definitely there are important performance indicators that we have to observe in order to identify any unfortunate deviation from the plan, and thus we will be able to make the corrected actions on time. Let us start with the first topic, which includes the objective mainly of the nature, discussing the nature and the purpose of a business plan. The first question that we need to address: why? What's the need behind having a sound business plan? First of all, we have to know that a business plan is definitely a roadmap. There is a current situation, we exist in the marketplace. Probably it's a startup, probably it's an existing company. Business plans are not only restricted to startups, even existing companies that probably have been in different marketplace for decades will be obliged to conduct and to formulate a business plan, probably for an expansion project or for a newly developed product. Any market development or any new market penetration necessitates a sound business plan. So this business plan, first of all, serves as a managerial tool, which is a roadmap to tell you how shall you move from a certain situation until you reach the desired outcome. The desired outcome is where to go, and the business plan is how to go there. So therefore, a business plan is A to Z model. It's an A to Z model that tells you how to really attain that desired outcome. And this is very important for any manager, for any leader, for any entrepreneur to use this business plan as a roadmap so that you can maximize the probability of success in the marketplace and minimize any possible failure or risk that probably your business is not gonna do well. The second reason behind the business plan, in addition to serving as a managerial tool, now we need the business plan to bring capital. So when I say I need capital, that is very important for startups. That's very important for entrepreneurs. You might be an entrepreneur and you have a brilliant idea. Your business model looks really great, so lucrative, so profitable. However, you lack financing. You don't have enough funds. So you need to really attract some capital from external sources. What are the external sources of raising capital? Well, first of all, we can rely on some debt financing. And by debt, I mean you borrow. You use that money as a leverage to really boost your company and really convert that idea into a real business. So you need this financial leverage, this financial support. So you might go to a bank and then you need to apply for a commercial loan. Now, most of the time, banks will ask you for a business plan. Not a single bank is going to accept granting you, I don't know what sum of money, thousands or millions of riyals for you to start that business. So the bank has to make sure that your business looks good, your business looks profitable. So the business has to be prepared very carefully, and you have to show evidence. All the assumptions that you put in your business plan have to be scientific so that they are convincing. So a convincing business plan is very important. Figures, financials, market information, market measures, market assessment, well, all of that should be done with extreme care. You have to show all the evidence, and you have to show that your assumptions are really based on scientific ground. And this is only when banks might accept giving you or granting you this credit application. You will be given the loan on that basis. However, if you go without any business plan or your business plan is weak, then definitely banks are not charity institutions at the end. They look for profit. And that's why they have to do a thorough due diligence on your business plan. They will scrutinize it. And then they will ask you for an interview, for a presentation sometimes. You need to present your business plan. And then there are specialists who will be challenging you with their questions so that they know very well how much confident you are in the information or with the information that you are presenting, and how much confident you are, and how much serious, devoted, committed about the business idea itself. How much experience you have running a business like that later on. So this is very important. That's at the level of soliciting a bank loan. On the other side, you might also get enough financing, not only through banks. What about equity? The word equity in business and in accounting or finance reflect capital that you bring from the owners. Now, you have the business idea, you own the business idea, you will be the initiator of that business, of this startup. However, you don't have the money. So, however, you know that some people, individuals or probably institutions, might have enough capital. They have savings from long time, and they have capital in millions or in billions of riyals, and they are always looking for opportunities to diversify their investments. So why not bringing those people as partners? So with this, they contribute capital, you contribute your expertise, you put your knowledge, you put your know-how, they put the money. And this is how you create that venture. That's what we call venture capital, when you invite individuals or individual investors who have enough money to invest in such startups. That's what we call, this model of financing is called capital venture or private equity. And this is how you raise equity financing. Again, those people are really smart investors. You cannot just tell them a story that you believe is true about your business. So it's not about telling a story, it's about talking about that story, writing up your story in a business plan. This is more convincing. So the conviction level is gonna be higher when you really make a story about your business plan that is so explicit, that is so detailed in probably 20 or 30 pages. This is your business plan, and then you give it to those people, you give it to those individual investors for them to again do the due diligence. They make their own assessment, they evaluate the business plan, and they believe, if they ever believe that they have any interest and they are convinced that this business is going to bring enough profit to cover their required return from that investment, they will be therefore interested to put that capital into your business. So this is how we understand the need behind the business plan. Now, for your story to be convincing, well, there is a self-assessment exercise. At this moment, you as an entrepreneur, as an initiator of this business idea, well, you have to appear like being highly motivated. This self-motivation should really appear from your interest. So the way you write your business plan has to be engaging. You have to show the readers, banks or probably individual investors, for either debt financing and or equity financing, you have to show your personal excitement. So you have to be so interested, enthusiastic about the business idea. So this is very important. The second point, determination and the drive. When I say determination, well, how can we really identify that that person is highly determined about this idea? Again, the interest that you show, okay, your work experience, your long work experience, okay, the intuition that you have really built, the leadership that you have, all of that should be expressed in a write-up, in a narration. You have to put it in your business plan so that again you appear to be a determined person who puts objectives and is willing to work very hard day and night for the purpose of achieving those objectives. Because you have to be dedicated, determined, with an internal drive to work very hard, then at the end you have to make some trade-offs. We know very well that every individual looks for a balance in general between quality of life and quantity of life. When you have to initiate a business as a startup, as an entrepreneur, unfortunately, you might face some imbalances between quality versus quantity of life. Well, you have to make sacrifices here, and that's what I call what I refer to as being a trade-off. Definitely you have some personal interests, some personal hobbies, some personal affairs, family life. Again, there will be some sufferings in the beginning because you need to put some time. Some entrepreneurs put not less than 14 to 16 hours of hard work per day, at least during the first phase, at least during the first or second year, until that business accelerates and it becomes one day an angel. And then that angel becomes a good business, a business with high value, that has a value in hundreds of millions or sometimes even billions of riyals. So at the beginning, as I said, there is a trade-off. There are sacrifices that you have to make so that in the long run, 2 years after, 3 years after, there will be definitely a positive payoff. Again, as an entrepreneur, you have to take lead in all of that. And that's why you have to accept the fact that you're going to be responsible. So it is your responsibility to make that business a successful business. So with responsibility comes accountability. They are intertwined. They are interrelated, actually, the two terms. Well, in case of success, you should be rewarded for that success. And the reward shall be in the form of profit, more liquidity, more cash flow, and on top of that, the value of that enterprise. We have heard a lot about startups that after 4 or 5 years of operations and success in the marketplace, well, they were so successful in selling the startup at a price of $1 billion, $2 billion, or even more. So this is very important. And the startup of that business was just a capital of $100,000 or $200,000. So 4 years after, that business that started with this small capital was capable to reach an enterprise value and to be sold out to large businesses in millions and billions of dollars. So this accountability, in case of success, it's going to be a reward. And in case of failure, unfortunately, again, you have to take the blame yourself, because you're the entrepreneur and you are the leader at the same time. Again, within this element, nature and purpose of the business plan, now that I know exactly what my business idea is, I know what responsibility I have, I know that I should be fully accountable for success as well as failure. So now, to maximize success and avoid any possibility of failure, it's very important to gather information. Okay, before you delve into the business, before going into the marketplace and invest whatever money you need, it's very important to know the market very well, to know your business very well and all its ecosystem. A business is never located in an island separated from its surrounding. A business exists in a marketplace that is so dynamic, that is so complex. It has a very complicated ecosystem, so you need to understand that ecosystem. You have to understand the business environment very well. And this necessitates gathering information about the business you want to start and about its environment. Now, how to gather this information? As you see here, there are two sources of information gathering. The first source is collection of primary sources, primary data sources. By primary, I mean, well, you go yourself and you search for that information. You get it. Mostly, you rely on some interviews, on some meetings that you need to do with some experts, with some consultants, co-workers, colleagues, okay, peers. So you have to really maximize your meetings and never miss or lose any opportunity to interview or to meet someone who might have enough expertise in that field so that you make yourself more knowledgeable. So we have to learn. Entrepreneurs learn. Learning is dynamic. Learning is a process. It's a long-term process. So we continuously learn, and we should not be embarrassed. In contrary, we should be embarrassed when we believe that we know everything, and in reality there are many things that change every day and we have to learn them. So this is one way gathering information. Another way gathering the information is through secondary sources. Well, by secondary sources, I mean there is already lots of information that you can find in the marketplace from various sources. Well, what about the government? The government has lots of agencies, ministries, okay, and you have lots of information. On most of governmental agencies' websites, you have a statistical section that shows census data. Let's take, for example, okay, the volume of trade, imports and exports. Well, you have the customs authorities. They have their website, and then you can really check the volume of exports as well as the volume of imports for every single commodity. Whether that commodity is a raw material or it's a finished good, at the end there are always statistics that is available for people to know about. So again, it's very important to gather this information, put all those reports, all statistical information and reports in front of you so that you educate yourself and you make yourself more and more knowledgeable. What about published materials from trade associations? Well, there are many trade associations, syndicates, engineering syndicates, pharmaceutical syndicates. Okay, so there are many regulatory agencies that have their own libraries, digital and sometimes even physical. So you can just spend time, hours and hours, days and days, okay, browsing the internet so that you can really get, okay, information about the marketplace, about the environment. There are so many things in the environment that you have to learn and you have to really make yourself knowledgeable about. That's what we also reflect as the Pastel analysis. Well, is it important to study the political environment? Yes. Is it important to study the economic environment, to know the economy in general, whether the economy is gonna rise or not? Definitely yes, because any business has high correlation with the economy. When the economy progresses, then your business is gonna progress. But when the economy goes back into a recession, then you have to be very, very careful, because people income, disposable income, is gonna decrease, and with this their purchasing power will decrease as well, and in that case you might not be capable to achieve the sales quota and the sales objectives you really plan to attain. So again, that's very important. That's the second element of the environment that we have to know, which is the economic part, in addition to the political situation. Again, I said Pastel analysis, so there is an S. What does the S reflect? Well, an S reflects the socio-cultural environment. We have to understand the social factors that exist in a certain market. Not all societies are the same. Families are different. Family values might be different. Okay, the way people create their social communities are different from one market to the other, from one community to the other community. There is not just one culture in a country. Even in the same country, as small as Qatar and as large as the US, for example, you will find subcultures and different ethnic groups. And again, you have to really learn their habits and their cultural beliefs as well as their cultural values, so that you really understand what type of people, what type of customers are you going to reach, how to communicate with them, what messages you need to address, so that you always understand their needs, and accordingly you arrange your offerings to make those people satisfied, even though they have different needs and they have different characteristics. So unless you make that exercise and you collect this information yourself, you will never know it. The T stands for technology. Well, can you imagine these days a business that does not really study the technology that is available for that particular business to accelerate? What best technology or technologies you need to use for the supply of raw materials, for your operations and manufacturing, for your marketing and sales, for the customer service. So all along this chain, you definitely need to use technology. What best technology you need to use so that you can really make your customer service, your product, a better quality, a higher quality product at a lower cost. So technologies these days are accelerating. The technological factor is changing momentumly, and that's why every business leader, every manager, every entrepreneur should be always aware of those technological changes and their impact on the business. You cannot really understand all of that unless you really gather this information. Now, again, within the nature and purpose of the business plan, it's very important that you learn how to write up the business plan. Now, it's very important at this level that we understand the nature and the need behind the business plan. Why is it that important? Now, we have to be technical and learn the steps we have to follow. So the 8 steps that you see now in front of the screen or in front of you are actually 8 essential topics or 8 essential sections that should exist in any business plan. What about the executive summary? An executive summary is a 2-page or something like 500 words, okay, summary of your business plan. If your business plan consists of 20 or 25 pages, sometimes individual investors who have interest to read your business plan so that they know whether they can invest their money or put funds in your business or not, first thing they read is the executive summary. The executive summary should be a convincing story. It should not be long, as I said, no more than 2 pages. It should take only 2-3 minutes for a reader to read it. So you have to make it a very convincing story so that any reader finds your business model really good, it sounds great, and then if they believe from the executive summary that your business plan and the results you aim to achieve on the marketing level and at the financial level are really convincing, then for sure those people are gonna spend more time now reading the whole business plan. But at the beginning, no one is gonna put time to read 25, 30, or even 40 pages unless they see something good in this business plan. How to see that good thing? It's the executive summary that should be your key for really attracting or making those readers interested in all the topics and all the elements later on of your business plan. So just when you write this executive summary, then you have to talk more about the nature of your business, the business idea itself. And that's what we covered already so far, okay, when I started in the first 30 minutes of my presentation. The third topic that is very important is the business model. You have to convince the banker, the creditor in the bank, as well as you have to convince this individual investor that your business is sound. For that reason, describing your business model is very important. How shall you integrate your products and services in the ecosystem of that particular business? There are partners that you need to deal with. There are certain customers that you have to reach. You need to do some key activities. You need some key resources. There are certain costs that you have to pay. But at the same time, you expect some income, some revenues. So the business model has to address all those elements that I just discussed. Throughout the presentation, I will be discussing one of the most important tools that consultants use for the purpose of describing a business model, and that's what we call the business model canvas, the BMC approach. Fourth, we have to now move into the market assessment and describing competition. It's more about describing the market, determining the market size. Let's do a competitor assessment. Who are the competitors? Where are they? What are their key challenges? So if they exist, they definitely represent some challenge, some threat. So what is the source of that threat? What makes those competitors really distinctive or so superior? What is their key selling point? So we need to understand everything about our competitors. Just once we understand the market and the nature of competition that exists in that particular market, the fifth topic is the marketing plan. Yes, we have to have a good marketing mix program. What is the marketing mix? It is all about what we call the 4 Ps: product, price, place, and promotion. Your business plan has to include, okay, the activities you intend to undertake to implement at the level of the 4 Ps or at the level of the marketing mix. 6, operations management and planning. Well, marketing is great because marketing is your market success or reflects your market success. However, this market success requires a strong operations that starts with a strong organizational structure, a good system, good processes, well-designed processes, operations at the level of manufacturing, at the level of procurement, supply, customer service. Okay, so at all levels, you have to have strong operations and well-designed processes. Combined with a good organizational structure, definitely this is a strong leverage for your marketing success. Now, marketing success, a strong organizational structure, well-designed processes should lead to financial success. And this is the most important. In a business plan, everything is important, but the most important is the financial results. The credit officer in the bank is eager to see whether you will have enough profit at the end of the year to pay back your debt obligations to the bank. Interest as well as paying part of the loan itself. Well, will you have enough profit and liquidity to pay back these obligations? The same is true about the individual investors. If you have succeeded to bring in equity financing in the form of capital venture from individual investors, again, those people are eager to go into your financials, to scrutinize and assess your financials from A to Z, just to make sure that you will have enough profit, financial profit, again, to satisfy what they require as a return from that investment. They are not going to put their money for free in your business. So that's very important. You have to show sound financial forecasting and good financial analysis. The second topic about preparing a business plan is about the business idea and the legal form. So when I say the legal form, what is meant by that? By this, actually, we're talking about the legal form of your business. Not all businesses are formed in the same way. Most of the businesses have different legal forms. So some businesses start very, very small. Sometimes they even start as micro firms. A micro business is a business that is normally owned by one person, and that person is at the same time the general manager, at the same time the marketing person, at the same time the person who does the accounting and finance. So he or she does almost everything. So this is a micro business. In that case, we refer to that business as a sole trader or a sole proprietorship. A sole trader is, as I said, one person who owns all that business. And he or she is the one to make all the decisions about that business. For sure, if your business idea is simple, so this is how you start. Many businesses started like that. Even large businesses and multinationals that people know. Amazon is now rated among the top 5 global companies in the world. Back in the 90s, in the mid-90s, they started as a very small business located in a garage in the United States. Okay, just gathering used books and selling them later on. They acted as intermediaries or as middlemen, okay, to buy books. So this is how they started. So very small and limited operations. Now look where Amazon is right now. So there is no harm at all to start that much small. Provided you work hard, provided you make the right decisions, then definitely there is a positive payoff. And when your business grows, then this will require additional capital. In that case, working alone might not be feasible anymore, might not be acceptable anymore, because you cannot really put additional capital. Now you probably need some additional millions of reals, and that's why you might convert your business from a sole proprietorship into a partnership. In a partnership, you invite more partners, 2, 3, 4 people join their efforts together and they work for that partnership. Okay, so they divide the responsibilities. Each one is going to play a certain role, and this is how they run the business. For sure, they have more power now in terms of bringing additional capital to the company. This is really important. Now, one common characteristic about a sole proprietorship and a simple partnership is that they both suffer from a disadvantage, from a drawback called unlimited liability. By unlimited liability, I mean that in case the business is gonna face some financial issues and the business is not really capable to recover itself from financial losses, at a certain point that business has to declare bankruptcy. As a result of bankruptcy, what happens actually? As a result of bankruptcy, and under Chapter 7 in the US and in many other countries that's the same thing. The company shall be decided upon by the courts, so that its assets, its belongings are gonna be sold out. They will be liquidated. And in that case, if the proceeds or the money you get out of selling all the properties of the business are not enough to pay back all suppliers, banks, and all creditors what you owe them as money, then in that case, unfortunately, you have to liquidate your personal properties as either a sole proprietor or a sole trader, or even as a partner in a business. You might be asked to sell your personal house. You might be asked to sell your cars, your diamonds, and whatever personal possessions and personal wealth you have. This is the drawback of starting actually a sole trader and a partnership. That's why when businesses really grow and then they require hundreds of millions and billions of riyals, at a certain point they have to think about changing their legal form. And the best legal form is going to be probably somewhere between either a limited liability company, what we call an LLC, or probably the ultimate level is to have a corporation. A limited liability company is a special form of a partnership that can be private. However, it gives the partners this opportunity to protect their personal wealth. So the unlimited liability drawback or disadvantage does not exist anymore here. The good thing about it, and that's why we call it limited liability, because there is no personal liability on the side or on the shoulders of the owners. So this is why we label it limited liability company. It can be privately owned, so there are some people who own that business. They don't really sell their shares to outsiders, so it's always privately held. At a certain point, if that business keeps on growing and growing, expanding and expanding, with an asset base of billions of riyals or dollars, in that case, well, you need another structure. You need another legal form. Most likely the legal form in that case is gonna be like a corporation. A corporation is more a public limited liability company. So when this LLC becomes public, then it is actually a corporation. We refer to it as a corporation. In a corporation, you have a board of directors and you have shareholders. Actually, the shareholders who own the common shares are the ones to vote for the board of directors. So the board of directors are elected from the shareholders, and then it's the board responsibility to hire the chief executive officer, a CEO, and in her or in his turn, the CEO is going to hire the rest of the directors in that particular company. When you reach the level of a public corporation, then there will be complete separation between the owners, who are the shareholders, as I said, and the directors. The directors, from the CEO to the other responsibilities and roles, managerial roles in the company, are usually hired from outside. So they are not owners, they are not necessarily owners, even though some of them might own some shares in the business, but not all of them are required actually to be shareholders so that they become directors in the company. Again, there is no unlimited liability. Corporation is a limited liability structure, and that's why every individual or institution who owns shares in that business, the maximum loss that you can really face is losing the value of the share that you invested in that company. But no losses are gonna accrue on your personal properties. Now, what's the next question? Now that I know very well what business structure, definitely for startups, you have to think about, okay, a sole proprietorship, and if you really invite some partners to put some private equity, then you have to think about like a partnership. And later on with the growth, as I said, you have all the right to change your legal form. Once the legal form is determined, you know exactly what is going to be your legal charter or your legal license to operate in that particular market. The next thing is to choose a name. Your business, as well as the products and services you aim to develop, should have a certain name. So selecting a name is very, very important. Now, and selecting a name, in addition to being important, it's also challenging. So contrary to what many people think, that choosing a brand name is something very easy. It's like, okay, giving a name to any object in life. No, that's not the case. Because when I have to go now with you through the elements or the 7 criteria that really make from your brand name a good name, then you understand that this exercise is really challenging and you have to be very careful in choosing your brand name. Well, among those criteria or characteristics that really make from your brand name or from your name something good is the distinctiveness of that name. It has to be distinctive. It has to be unique. Think about Xerox, for example. Well, Xerox in the US, as a word, Xerox has no meaning. Okay, so the initiator of that company just thought about that name. Now, because it was so unique in its nature, and Xerox as a company worked very hard to really make from that name a successful brand, that's why they have succeeded. Until that name became later on a generic word and even an action verb. In the US, people rarely say, please photocopy that document. They most of the time say, please Xerox it. So Xerox has become an action verb for any document you need to photocopy. So this is the distinctiveness of that particular name. The second criterion is brevity. By brevity, I mean the name has to be short so that people can easily recall it. I don't have to think a lot to really remember or recall or even recognize the brand. For example, Nike, Tide, Yes. Okay, so all of these brand names are really short and they really give people the chance to remember them very easily, to even pronounce them very well. So that is actually criterion number 4. Again, another criterion, which is the third one here on the list, it's the appropriateness of the name, i.e. the name has to suggest in certain cases something about the product. If you take batteries, for example, you have different brands of batteries. Among them, you have Energizer, you have Duracell, which is durability. It's a cell of durability. Energizer, it gives energy. So such brand names are really successful because they suggest something very important about the benefits of that particular product. So again, that took time. People did not just think about those brand names just by having some coffee time with each other. No, they thought a lot. Lots of brainstorming sessions, lots of exercises, crowdsourcing of ideas, just to identify a good name. Easy spelling and pronunciation. The example of Apple, very easy. The example of Nike, very easy. Yes, Tide. All of those examples are again under that umbrella. The fifth criterion is likability. Well, the brand name has to touch both the heart and the head. The head in terms of recall and recognition. In terms of heart, there should be an emotional bond. So this brand name has to really help the company to reach the heart of the potential consumer, the potential buyer, so that there is some emotional bonding between the brand, between the product, and between the consumer. Many people are loyal to a certain brand. Many people, you find them only buying, let's say, Dell as a laptop. Why? Because there is an emotional bond. Many people, when they have to replace their smartphone, they always look for the newest iPhone or for the newest Samsung or for the newest Huawei. at this point in time, why are they just loyal to that brand? This high level of loyalty indicates that there is something that really touched their heart as an emotional bond between that brand and themselves. The sixth criterion is about extendability. The brand name has to provide its owner, i.e. the entrepreneur or the company, the advantage of being extended to other markets or probably to other products. Again, Apple is a very good example. So if you take Apple, they have really succeeded to create laptops under the name Mac. They have their iPhone, they have their iTunes, okay, they have their AirPods, and they have a wide array of items, and all of these items have the same family name. It's always Apple. So if Apple now decides, let's say, to start producing a hardware TV set under the name iTV, for example, then can you imagine how much successful is this TV set going to be in the marketplace? Simply because it holds the name of a very strong company. By the way, Apple is the most valuable global brand in the world. It has currently a value that approached $300 billion, the value of the name only. I'm not talking about the value of the whole corporation, only the value of the name. If you take Caterpillar, the famous US manufacturer of heavy-duty machinery and building materials, construction equipment. So what have they done? They have really extended the brand name to produce, shoes. Well, the type of shoes they have produced are not really soft shoes as running shoes. No, they have really succeeded to produce shoes that can be used for outdoor camping, for outdoor activities. And why? Because they reflect the durability. They reflect that they are really hard. They are very durable and can be used for heavy duty activities. Protectability is the seventh and the last criterion behind a good brand name. So when I say protectability, I mean you have to make sure that the name you select is not already used by another company. Because the moment you decide upon a brand name, you have to make sure that you get a trademark for that name. How to get a trademark? Very simple. A trademark should be obtained from some legal governmental agencies. In many countries, that's the responsibility of the Ministry of Economics or the Ministry of Trade. In other cases, it might be the responsibility also of the Chamber of Commerce, because you also have an ICC, the International Chamber of Commerce, that can also give you guidance about how can you protect your name and thus discourage and even prohibit any other business to use that name or even to use its catchy logo. Because every time you think about a name, you always need to think about a logo. The protection in terms of trademark, it's not only about the name. The protection you get is for the name as well as for the logo. For that reason, it's very important. So that if one day you find any business using that name, then you have the legal right to raise a lawsuit against that particular business. And then you charge them fees and penalties, financial fees and penalties for using that name up to a certain point in time. Now, when it comes to the business idea and the legal form, so actually for the business idea and the legal form, I'm going to be talking about the business model canvas. In that business model canvas, you see actually that there are 9 rectangles in this model, and each rectangle reflects something. So actually we have, as you see, we have to develop channels and we have to build long-term customer relationships. Now, first of all, and prior to that, it is very important to identify the value. What is your value proposition? What do you promise? What do you promise your customers? What are you promising them? That is very important. So when I say, what do you promise your customers? What benefits are you promising them? That is the first thing you need to do. Value proposition is the diamond of your business model canvas. So many businesses, if you take Volvo for example, Volvo promised safety, they promised durability. Porsche promised luxury and performance, the same as BMW. So any business has to have a certain value proposition. What are your points of differentiation? What we call the PODs. What make your business different from other businesses? That is very important. Also, if you really compare your business and your products to some other benchmarks of other businesses that are very successful, again, it's very important to say, what are your POPs, the point of parity? What are the similarities? How you compare your startup, your new product to a product that has been in the marketplace for probably 10 years, 20 years, or 30 years, and that product has become very strong. So where is the equality? Definitely you have to show some equality, and at the same time you have to search for some superior points that will make your product shine and it stands really superior in that marketplace. From value proposition, it's very important to really understand, okay, the customer segments. Who are the customers? Who are they? And that requires actually an exercise in segmentation. Who are the segments? Who are the buyers? In that particular case, you have to do the segmentation exercise, as I said, so that you identify your target market. Segmentation and targeting shall be discussed in detail in another section of that presentation, which is part of the marketing plan. We come to the third part, which is the channel. By channel, actually we mean, how shall we communicate and how shall we exchange goods and services with those customers, with the customers that I chose? How shall we really do that? So you have to be very specific in describing your communication channels that you will be using to send marketing messages, and at the same time you have to be so explicit in describing your distribution channels. How shall you make your products available on the right place at the right time and at an affordable price? This is very important. Now, answering the two questions, communication channels and distribution channels, nowadays we see that most of the businesses rely on multiple channels and not only one. You need to think in your business plan about what type of business channels you can probably build so that you make your products distributed physically and make them available in stores in physical places. This is one. At the same time, your business plan should address the possibility of having your own website for e-commerce, for shopping, for e-shopping, and that is gonna be the online distribution. So in that particular case, blending or combining all of that together, combining digital channels with physical channels as one network, as a blockchain if you want, like the blockchain of cryptocurrencies. Now the same concept can be applied here. Well, I need to design an omni-channel. The omni-channel is this blockchain, this network that puts together online channels and physical channels of distribution as well as communication, so that they all function as one system. Rather than being competing against each other, they complement each other. We don't take them anymore as substitutes, we take them as complementary businesses that come together for one ultimate goal, which is customer satisfaction. Also, the business model canvas integrates customer relationships. It's very important. It's very important to show any reader, whether that reader is the banker, the credit officer, who's gonna sign at the end of the day the credit approval, the loan approval, or whether you're addressing your business plan to the individual investors, and on top of that, it's your business plan. Remember, it's your roadmap for success. Now, sometimes you might have millions and billions and you don't need external financing, but still you need a business plan. Remember that. So your business plan has to show the activities and the programs you intend to undertake and implement for the sake of building long-term and profitable relationships. It's very bad for a business to attract a customer and then lose that customer from the first purchase because of dissatisfaction or because of a weak customer service, because you failed to satisfy that person. You failed to stick to your promises. Remember, the value proposition that I mentioned earlier is nothing but the set of promised benefits. You promised 1, 2, 3 benefits. If you failed to deliver those benefits, then definitely customers are gonna quit. Customers have the freedom to leave the relation at any point in time and look for other relations with other brands and with other companies. So that should not be the case. In your case, you have to show that you're working hard, and you will be working hard day and night for the purpose of making your customers satisfied and even delighted, so that they repeat again and again their purchases. And this is how they become loyal, and this is how the customer lifetime value increases, as well as brand loyalty and brand equity. The customer lifetime value is a financial measure that you can calculate for the purpose of determining how much income you can make from each customer throughout the relationship with him or with her. So this is very, very important. So if those relations are not really long-term, the CLV, the customer lifetime value, is going to be very, very small and even negative. And this is something you need to avoid. To make sure that your CLV, that brand equity, which is the value of the brand, as I said earlier, the brand value of Apple is almost $300 billion. So this is what I mean by brand equity. Don't you think that every entrepreneur should be working hard to make from the brand that he or she is initiating, that he or she is pushing on the marketplace to reach this high level of value? Definitely. Two other drivers or two other elements, constituents in this business model canvas: revenue stream as well as key resources. Well, when I say revenue stream, what is meant by that? Again, in your business model, you have to convince the reader, and you have to convince yourself as a manager, as a leader in that business. Well, how can I make money? That's the question. How can I make money from that business? How can I really convince people to buy? What is my selling strategy? What type of sales management, what selling techniques, professional selling techniques I'm gonna adopt for the purpose of bringing more cash flows, cash inflow through sales and through revenues? You have to think about probably adjusting your prices from time to time. And that is also something we will be addressing in the marketing mix plan in the other parts that will come later on. But for sure, manipulating your prices or changing your prices, modifying your prices from time to time is really essential for the purpose of really managing your revenues. When the season is high and you expect high demand, then you keep your prices high. During low season, and if you have end of stock items at the end of the season, it's really important to reduce your prices. Use some promotional pricing so that you can convince and stimulate more and more buyers to buy large quantities, provided you give them this discount. Again, you have to think about some other strategies to generate revenues from other sources. What about cross-selling? You have to train your people in any business. So anytime a customer places an order to buy one item, they have to be trained how to convince that client to buy another item as well. And that's what we call cross-selling. How many times it happens, okay, with you and with any person you know, you go inside a shop to buy a t-shirt, for example, and then you find yourself buying a t-shirt and a pant, or a t-shirt and a jacket. Why? Because the salespeople were very smart. They were highly trained to convince you that it's really good to buy this second item or this third item. So again, cross-selling is one important selling strategy in your marketing plan that you have to show in your strategy and your business plan. Upselling, again, that is something else. You might convince people to buy the low quality or the low version, the low end product that you have, so that one day they do the upgrade. How many times you offer new products for free, and you find actually many companies launching new products, and they give a subscription, a free subscription for free in the beginning, assuming that this product is an application, it's a mobile app. They tell you, well, there is a free download, but when you start using this app, you see lots of benefits. And then they tell you, okay, fine, for you to gain those benefits, there is a premium. You need to upgrade, okay, your service from a free service to a paid service. So this is also another way to generate revenue. Again, revenues cannot be generated if you don't have resources. Okay, I cannot sell something if I don't have the resources. What resources you need? First of all, you need to have land. You need to have buildings. You need to have equipment and machinery. All of that is called properties. You need to have raw materials. If you want to produce a physical good, a tangible product, you cannot produce a tangible product if you don't have the raw materials. So all of this, or all this mix of resources, require funding. You need money. And that's why, okay, you are writing the business plan. That's one reason, so that you convince, again, the investors or the bank or the creditor that these are the resources that you want, and they will cost you this amount of money, so that they know if they have to invest 3 million Qatari riyals, for example, in that business, they have to know why. Okay, where is this money going to go? To acquire what? To buy what? What resources? So that's very important. Again, in this business model canvas in the BMC, it's very important to also reflect on 3 additional items. Okay, the key activities. What are the key activities? Well, you cannot design a product if you don't have research and design department. The research and design department includes technicians, engineers, people with technical knowledge about graphics and about product development, about packaging, about the engineering of a certain product. So these are activities that you need to perform at the level of operations and manufacturing. What about safety and health? That is a requirement these days. Okay, all companies are now obliged to really have some ethical conduct. You have to show an ethical behavior not only towards the community and society. Again, ethical conduct and ethical behavior is important when you deal with your employees. So the employees you're going to attract should be working under safe and good health conditions. And this is one of the main issues that you have to consider as well, so that you avoid and you are proactive in reducing any risk, any possible risk from taking place later on. Other activities might include automation and artificial intelligence. Well, what about your operations? What about your manufacturing? Will you be using some robotics, for example, automated and flexible or agile manufacturing? So these are some activities. At the marketing level, again, we can think about some activities, events, sponsoring some activities or some programs, okay, doing some promotional campaigns. So all of these are marketing activities that, again, you need to do. Who are your key partners? The business model canvas is very important to identify your suppliers. The suppliers are the companies from where you buy your equipment, your raw material, your supplies, and everything you need as an input for your production to start. So imagine you don't have good relations with your suppliers. So relations with suppliers can be, again, programmed. There are some software development companies that can help you in doing that. They can help you by really initiating or installing a software called SRM, Supplier Relationship Management, so that you can do better purchases, so that you can do better procurement, and then the order process is going to be more smooth and more automated, more direct. And this is how you really gain acceptance from your suppliers. Your suppliers will give you, as a result, some superiority, okay, over many other clients. So when you send your order shall be treated as a priority order and not as a secondary. It's a priority primary order for them, so that you can guarantee continuously a continuous flow of raw materials. Imagine if raw materials never come to your facilities, then you might have to stop production because you don't have raw material, you don't have supplies. So how can you produce something if you don't have its raw material? So for that reason, it's very important to understand who are your key partners and then work to build strong relationships with them. In addition to suppliers, intermediaries. Sometimes some suppliers cannot be reachable. They cannot be reached directly. You don't have direct access to them. You can only reach them through some agents, through some intermediaries. Again, having good relations with intermediaries is very important because intermediaries play an important role as middleman between your company and those suppliers that are essential and crucial for your business model to accelerate and grow. The resellers. Now we're talking about the demand side and not the supply side. At the demand level, there are customers who are waiting to buy your finished goods. So how shall they buy them? I spoke earlier about the distribution channel. Distribution channels can be physical and they can be online or digital through e-commerce. At the physical level, once you finish producing your products, you have to make them available at the right time on the right place. So what is that right place? The right place is probably a wide array of stores, retail stores and other stores, so that people can go there and buy. So what do we call these stores? We call them the resellers. Because again, they act as intermediaries to facilitate the flow of finished goods this time so that you can reach the end user or the end buyer. What about the cost structure? Again, when I said earlier, there are key resources that you need. Well, acquiring those resources is not free of charge. There is a cost to pay. You have to distinguish in your business plan between what we call a CapEx and what we call an OpEx. A CapEx is simply capital expenditure. It's the money you need to invest to acquire equipment, to acquire machinery, land, and to build buildings. So this is what I call a capital item or a capital expenditure, because you are investing money in a physical property that will last for several years. You can use your buildings for 20 years. You can use an equipment or a machinery for at least 5 years or 7 years. So any acquisition you make for any item that has an economic life exceeding 1 year, then we refer to that as being a CapEx, a capital expenditure. So again, in your business plan, you need to have a table that shows the list of items that you need to acquire and how much they will cost you, so that whoever is gonna share with you the investment in this business, they have to know very well how much money is needed to cover what, to buy what items. On the other side, what is an OpEx? An OpEx is an operating expense. By operating expenditures, I am talking about the daily expenses you incur, the consumption of supplies, when you pay salaries, when you pay wages, when you pay rent, if you pay for utilities like electricity, when you pay for any marketing campaign on social media or on traditional media channels. Again, all of that is considered an operating expense, because this is money that you spend and it is spent. It cannot survive for the second year. It will not stay for the years to come. So it is consumed during the same year it was acquired. So parallel to having a CapEx list, you need to have an OpEx table list that shows what are your operating expenses, at least for the first year, second year, and third year, so that again, investors as well as creditors like banks are fully aware of the money you need and the expenses you will be incurring from year to year until you become financially self-sufficient. Now that we are sure and certain and confident about our business model canvas, so now we know our business and we know the ecosystem of that business. The 9 elements, internal as well as external, are fully detailed. Now we come to the company itself, any startup or any business should have a mission statement. The mission statement is also an exercise that you need to do, and then that mission has to be explicitly written in your business plan. So I just found for you an interesting mission statement for Starbucks. So if we read it, that says, Starbucks exists to inspire and nurture the human spirit. One person, one cup, one neighborhood at one time or at a time. This is really great. They did not say in their mission statement that they produce coffee. No. They spoke about the needs. Well, when you go and spend 1 hour or 2 hours in a coffee shop, it's not only the coffee itself. It's not only those coffee beans that attract you to that place. It's the environment. It's the neighborhood. It's the ambience. So that's your real need. And this is how they were very successful in writing a market-oriented purpose rather than a product explanation. They did not explain what products they have. They defined their purpose of existence using marketing-oriented terms, touching the needs of people rather than reflecting on or focusing on the products they produce. Again, the shared values are very important. If you read the vision of Starbucks, it says to establish Starbucks as the premier purveyor of the finest coffee in the world while maintaining our uncompromising principles while we grow. Principles of good customer value, of good customer service, of this environment, the neighborhood environment, that is something they will never compromise. Even though they become the most global successful coffee shop in the world, which is somehow what they are, and they will always remember what their core and shared values are. So the vision acts actually as a future orientation. That's the future orientation of Starbucks. Now, why is a mission statement important as well as a vision? Companies don't write a mission statement so that they can reach their customers through the mission statement. No, in contrary, many people that think mistakenly, erroneously, that a mission statement is something that the customer is really willing to read. No, that's not the case. Mission statements are first of all written and they address messages to the directors. So that if you work as a shop manager at Starbucks, now you know exactly what type of service you should be rendering. You cannot be rude, you have to be polite, you have to be smiling, okay? You have to be sociable with the people the moment they come. Otherwise, you are against the mission. So the mission is a message that goes first to the insiders, directors, and employees. And then, if customers really want to know what the mission statement of that business is, again, that's really good as well. There is no problem, and that's why the mission statement is a statement that is published on the website of any business. So you can visit the website of any business and really read the mission statement. What about your startup? Does it have to have a mission statement? Definitely yes. Again, you really want to learn the best way of writing a mission statement. Once a mission statement is written, now we have to derive from that mission the goals and the objectives. So as you see, goals as well as objectives differ in their scope, in their time dimension scope. What is the time dimension of a strategic goal? A strategic goal as well as a strategic objective is a long-term goal. It is something you desire to attain, but probably 3 or 4 or probably 5 years from now. That is strategic. A tactical goal as well as a tactical objective is more intermediate. It's also about the time horizon, but this time the time limit, the deadline is maximum 3 years. It goes from 1 year to 3 years, and that is what we call a tactical goal. Operational goals as well as operational objectives are short-term outcomes. Well, I would like to achieve that the next month, the next quarter, or by latest end of that year. So any desired outcome that you want to attain, that you want to achieve up to 1 year from now is classified as operational goal. Now, what's the difference between a goal and an objective? A goal is a very general statement. Well, I added an example here just to tell you how broad is that goal. Going global. Going global is strategic because companies cannot become global, especially for startups. Imagine a startup becoming a global in, I don't know, 1 year or 2 years. Some of them might succeed, okay, but not all of them. Especially those that succeed are probably in the technology sector, and the whole company is a digital company. So they can exist everywhere. But think about companies that have physical products to produce. Then it's very, very difficult, very challenging for them to become global in few years. That needs time. Going global is broad. It has no particular dimensions. Now, if we translate that strategic goal into a strategic objective, and as you see, a strategic objective as well as a tactical objective and operational objective, any type of objective has to satisfy an acronym known as a SMART, S-M-A-R-T, where the S is specific, the M stands for measurable, A attainable, R is relevant, and T is time framed or time bound. Now, if we look at the strategic objective, and we call it SMART, so we use this SMART not to say it's intelligent for sure. We use it only as an acronym rather than a word by itself. So in that case, if I take going global and transform that into a strategic objective, then we can say develop 2 foreign markets in the MENA region by the end of 2025. And this is how this is more a strategic objective. Does it satisfy the S? Yes, it is specific because we're talking about becoming global in the MENA region. So that is the specificity here. Yes, we know exactly where to go. That is one. Is it measurable? Yes, because the objective states clearly that, well, your aim is to start 2 foreign markets, to develop 2 foreign markets. So the number 2 is the measure in that case. Is it attainable? Well, I don't think that is very challenging. It's not an impossible mission. You have somehow 3 years, to accomplish this strategic objective and to exist in 2 foreign countries. Is it relevant? Yes, it is, because going global as a goal, from that we derive that particular objective. Does it relate to that? So if you achieve the strategic objective, by doing that, are you ultimately achieving the strategic goal as well? For sure, yes, and that's why it is a relevant objective. And finally, is it time bound? Definitely, because we said, well, we allow ourselves to achieve that by end of 2025. Now, if we can really develop 2 foreign markets by end of 2024 or by mid 2025, that's even better. But if we fail, then there is a problem. Then it means we failed to achieve that objective. And here we have to really do some diagnosis in order to understand the reason behind that failure. So what I just now shared with you is very important as an example. When you have in your business plan to identify your goals and objectives, don't restrict them to one goal and one objective. You have to have a multiple of goals and objectives that revolve around many business functions. Some of your goals and objectives have to be related to marketing, others probably human resources. Another set of objectives are probably related to operations and manufacturing, and do not forget the most important on top of that are your financial objectives. What return on investment, what return on asset? Again, these are key financial performance indicators and objectives that should exist. So you need to have this diversity of goals and objectives that cover most of the dimensions of any business, mainly from marketing to management to HR to operations as well as finance. Now, again, a business should be located somewhere. So we talk about key location and personnel. Now, to what extent location is important? That depends on the nature of your business. Actually, if you think about a startup that takes the form of a chain of retail stores like kiosks or coffee shops or clothing shops, accessories, whatever, electronics, then location is very important. At the retail level, we say always location, location, and location. On purpose, I mentioned that word 3 times consecutively. That's not a typo. This is just to stress on the fact that location is the most important key resource. It's the most important element for your business success. That's why choosing a location is as important as choosing the brand name. Earlier, I spoke about the importance of choosing a brand name, and now you can see the importance of choosing a location. That might not be the case actually if your business is digital. So you don't need a location. You can run it from your own apartment probably. You can run it from a very small office. You just have to rent the office and then you can work from there. So in that case, you don't need it. Sometimes your business is not actually targeting consumers or individual buyers. Sometimes your business and the whole business model that you have aims to reach other businesses. So the customer you aim to reach is a business company and not an individual buyer. Again, a location might not be that important because most of the time when your clients are other businesses, you visit them. So you don't expect them to come to your place. You always render visits to their premises, to their offices, and that's why location becomes secondary here. In addition to location, what about personnel? Well, nowadays with LinkedIn and other social media platforms, chasing or hunting for talent is becoming more challenging. You might have a highly talented employee or director, but that person is always subject to be hunted by other businesses. Even multinationals these days can hunt people because remote working has become a norm. It has become a work norm. 3 years ago, 4 years ago, that wasn't the case. To be hired and recruited, you were obliged back then to go there and to work from the country of residence of that particular company. Now you might be living in Qatar and you work for a US company. You might be living in Singapore and you work for a French company. So from that purpose, okay, talent acquisition, talent recruitment, talent management, and talent retention is becoming more challenging. So you have to really act as a leader who inspires those people, who give them all the motivation in addition to a good financial compensation package, so that you never give them the opportunity to think about quitting, to think about working elsewhere. So this is really very important. We come to the third topic of the business plan itself, which is conducting a market assessment and doing a marketing mix planning. Now let us start with the market assessment. With the market assessment, for you to identify the market size, the size of the pie, it's very important to conduct market research. Market research is a research you need to undertake for the purpose of identifying the size of the market. The market size can be illustrated or described using different terms. First of all, you have to distinguish between what we call the potential market or market potential versus the available market. What is meant by market potential or the potential market? Here we're talking about all possible buyers who have the willingness to buy a product. Now, if you ask people, how willing are they to drive a Ferrari, to own a Ferrari? Well, you will probably find millions of people who will tell you yes for sure. But, well, do they all have the purchasing power, enough income to acquire a Ferrari? Definitely not. So the potential market does not distinguish between the people who are willing versus the people who are able. Ability to pay is more related to the available market. The available market includes only the people who are capable. They are willing and they are able to pay at the same time. So that is therefore the available market. Now, the available market that includes people willing as well as able does not necessarily mean that all of them will buy, because some of them might not see a priority now for buying that product, even though they are willing, but they might delay, they might postpone that acquisition. And that's why the target market might be smaller than the available market. And the target market is what you aim to reach, you as a company with your own products. Now, that target market can be equal to the available market if you really want to reach every possible buyer who belongs to the available market. Then in that case, the circle of target market might be equal to the available market. But definitely the available market is never equal to the potential market, because there is a big percentage of people from potential down to available that don't have enough money to pay. So, however, choosing the target market is your decision as an entrepreneur, as a marketing manager who works in that particular business. Do you want to target all people available in that market, or are you gonna take some sub-segments or subgroups and you consider this subgroup to be your target market? It is your choice. Now, if you consider your target market to be that circle in gray, then that does not mean that you're gonna succeed to make every buyer in this target market a true buyer or an actual buyer. Individuals who belong to the target market, some of them might be actually buying your product and others have not yet decided to buy your product. They might be buying other products or other brands from competition. So that's why the penetrated market is what you actually achieve from that target market as sales. What about the actual market size? The actual market size is not only your market size, it's not only your share from that market, it's what all companies in that particular industry, in this field, what all of them have achieved as an actual market size. It's your company's sales as well as all your competitors' sales volume. You add them up and that is gonna be the actual market size. Now, if the actual market size represents 50% of the market potential, as an example, then that is gonna be the market penetration level. So in the third item, when we say determine the market penetration level, then that is simply the actual market size divided by the market potential. So the more you improve your actual market size as an industry, not as one company alone, when all businesses and competitors in a certain industry work hard to market, to make more advertising, to create more campaigns, promotional campaigns, and with this they increase the size of the actual market size at a certain point, this might be equal to the market potential. So when the market size, theoretically speaking, if not practically, becomes equal to the market potential, then in that case we say the market penetration is 100%. So again, when it comes to that, market research is important because market research will tell us what's the market potential. Through market research we can know what is the actual market size. Through market research we can also know whether we have a low penetration. If there is a low market penetration level, it means you still have an opportunity to improve your promotion and marketing to sell more and more, because there is still a big percentage of people who have not yet bought that product category at all. Not your brand as well as not any other brands at the same time. Through market research, you can do a needs assessment. You can assess and evaluate as well as discover the needs of the buyers. What do they need? What do they want? What do they want to buy? And also through market research, you can identify what type of market are you facing and whether demand is elastic or not. By elasticity, I mean, if you increase your price by 1%, well, will people stop buying? If that is the case, then that is very difficult. In that case, you cannot think about increasing your price, because demand is very elastic. By increasing your prices slightly, demand is gonna shrink largely. So you shouldn't be doing that. When demand is highly elastic, then it's always better to reduce the price, because reducing your price in that case by 5%, let's say, is gonna increase demand by 20% or 50%, let's say, and in that case, well, you did a good job. So again, through market research, it's very important to identify all those elements so that you can later on in your marketing mix, you can make better pricing strategies. Now, again, it's very important when we do the market assessment to identify who are the buyers we aim to reach. Who are they? This necessitates doing proper customer segmentation and target marketing. By customer segmentation, we have to learn that not all people have similar needs. People who aim to buy even the same product will look for different attributes and benefits because they have different needs. Do all people buy the same brand of car? Do all people buy 4-cylinder cars? Do all people on the other side buy 8-cylinder cars? Of course not, because people differ. Demographically, they are different. Different age, different gender, different occupation, different income. At the behavioral level, again, some of them might be actual users. Some of them might be very loyal to the brand. Others are not loyal. And they are so price sensitive. They shift from one brand to the other. Again, behavioral characteristics make from some people similar, and it also makes from other people different. Same as demographic. When I say psychographic segmentation is one way understanding the different groups of buyers or segments of buyers using some lifestyle characteristics. What type of activities they do? Sports, social activities, probably no activities at all. This is something we have to know. What is their interest in life? Watching soccer games, for example, that might be your first interest in life, even though you don't practice, even though playing soccer is not your activity, but you have interest in watching at least soccer games. What about your opinion about nature, about the environment, and about so many other things? Again, people don't share the same opinion. And this is another reason that make them different from each other or distinct. Geographic, where do people live? Do they live in urban cities, suburban regions, or in rural places? Where do they live? Does this impact their buying style and buying behavior? For sure, yes. Usually in marketing, to properly identify the segments, like in that case, a bookstore named Bookends, as you see from the table, identified the 3 target segment profiles: the bored empty nesters, the busy families, and the hipster wannabes. So at the end, each segment of buyers has different characteristics with respect to those demographic, behavioral, psychographic, geographic. Now, combining or mixing geographic and demographic segmentation together is called geodemographics, and this is highly used in the segmentation process. Now, once you identify those segments, Bookends identified 3 different segments, but they have the right not to target all of them, as well as they have the right to target all of them. So your targeting strategy is simply choosing a market segment or some market segments in plural for you to target, for you to reach. You say, well, I want those buyers to become my customers. So you consider, therefore, that segment to be your target market. 3 targeting strategies are available, and in your business plan, you have to show exactly what targeting strategy you are pursuing. The undifferentiated one is the weakest. It's very weak, because in that case, you say, well, I have a product, and I'm gonna introduce that product for everyone. It's one version, it includes certain benefits, and then I will treat all the buyers as if they belong to one single segment. So you do not think about making different versions or different models of that product, because you treat all the buyers in the same way. So this is not really good from a marketing perspective. Now, if you really want to reach all the segments, then it's better for you to apply a differentiated targeting strategy. So that for each market segment, if you believe that that segment, the empty nester, for example, is going to be your targeted market. So what best marketing offer, what best product, what best way of communication, what best way of distribution I should be using with this segment. So the product design, the communication message, the distribution channel might be very good reaching the empty nesters, but the same product, the same communication message, the same distribution channel might not be appropriate if you decide to target families. So from that perspective, if you really want to target, in addition to the empty nester, families as well, then you have to think about a new marketing offer, a new marketing mix, so that you can better satisfy the second distinct segment that has a different need, that look for different benefits. Then you have to modify your marketing offer so that you can better appeal to those people. The same is true if you really want to reach the third segments as well. Again, you have to make further modifications on your marketing mix and on your marketing offers to properly satisfy and adequately make those buyers in this third segment satisfied. And that's why we call it differentiated, because for each segment you will be using a different marketing strategy. What about the concentrated? In the car industry, by the way, Toyota is a good example about a company that uses the differentiated targeting strategy, because they have very small economic cars for certain groups of buyers, and on the other side they have extremely huge high-end SUVs like the Land Cruiser, for example, to satisfy families with high income. So they have a very broad category, and between that very small car and this SUV, high-end SUV, you probably have 10 different models in between. So this is done as a differentiation strategy. Finally, the third targeting strategy is called concentrated. And with this concentrated strategy, well, the company decides to take one segment and divide it even into further segments, into sub-segments. In the car industry again, Ferrari is not really targeting all buyers of cars. They only target people who are looking for a sports car that is very luxurious at the same time. So that's what we call a niche market. So that could be also a very good targeting strategy. Well, I'm only concentrating, and that's why we call it concentrated targeting. Now, when we have to describe competition, again, in your business plan, it's very important to show any reader that you fully understand not only the market, but you also understand the nature of competition that exists. Now, when we have to study competition, we have to think outside the box. We cannot really follow a narrow approach. In a narrow approach, you might mistakenly think or believe that your competitors are only those companies that sell highly similar products, like McDonald's and Burger King, because they are head-to-head competitors. Then you might think that the only competitor for McDonald's is Burger King. The only competitor for Pizza Hut is Domino's Pizza or other pizza restaurants. That's not true. That is not true, because competition can be that much direct and it can also be indirect. Michael Porter succeeded actually to describe competition by looking into 5 dimensions. So you can consider each source of competition from that particular threat. First of all, he says for sure, competition is the highest when it comes from your existing rivals. Just the example of Pizza Hut versus Domino's Pizza, or Burger King versus McDonald's, or Pepsi Cola versus Coca-Cola, or Ooredoo versus Vodafone. So this is actually what we say threat of existing rival. That is for sure the highest level of competition. Well, that is correct, but this is not everything about competition. What about substitutes? a substitute is any other product or company that exists to satisfy a similar product, a similar need, if you want. So, if you really feel hungry, you might decide to eat a burger and you might decide to eat some grilled meat or some fish. So at this moment, you can see that competition is not only a burger versus a burger. It can be a burger versus any type of food, because any type of food is a substitute. Third, the threat of buyer's power. Now, if you are a subscriber for Ooredoo or Vodafone, as a buyer yourself, you don't have enough power, because if you're not satisfied with Ooredoo, the only other option is Vodafone and vice versa. If you're not satisfied with Pepsi Cola, then the only competitor is Coca-Cola. Then in that case, again, the power of the buyer is weak. When the buyer feels that he or she is under the mercy of that brand, then in that case, this is low competition. But when the buyer has many other options, you can choose from a wide array of alternatives, then you are more powerful, and this will make the nature of competition higher. What about supplier's power? Well, if you have a franchise company, Five Guys, for example, in the burger industry, if Five Guys are obliged to buy their meat only from California, then they live under the mercy of the supplier, because they cannot choose any other meat supplier, even though there might be some better meat suppliers from Australia, for example, but because of the franchise contract, then they have a limited reach for suppliers. They can only buy meat from certain designated meat suppliers from the US only. So this makes those suppliers very powerful, and this increases actually the level of competition in the marketplace. What about a new entrant? A new entrant is any new company that might start operations in the near future or in the foreseeable future. So you have to be aware that you might face competition in the future from new companies that might enter. Now, how much it is easy to enter a new market? Are there some legal barriers? Are there some entry-level barriers at the level of technology, at the level of regulations and laws that might protect some businesses? So this will make this threat very low. But if new companies have complete freedom to start their business anytime they want, this will make from the competition even more and more intensive. Once you have succeeded to study the environment, it's very important in your business plan to do a SWOT analysis. In a SWOT analysis, we have to analyze 4 dimensions. We have to identify our strengths. What are they? What are our key competencies? And we have to know what are the weaknesses of the company. Any company has strengths as well as weaknesses. There should be always an area for improvement. If you believe that your company does not have a weakness, then you are completely eye-blinded person. No, any company has certain areas for improvement. So you have to do a thorough internal assessment of your operations, of your marketing, of your financials. Human resources. If you have a new brand, if you start a new company and the brand is very new, then this is a weakness because no one knows your brand yet. So this is an example of a weakness. And this is something that you need to reflect in your strategy later on. What are the measures? What are the events? What are the marketing programs that you will be utilizing for the purpose of improving your brand presence? Opportunities and the threats are more external. With this, we study the external environment. Earlier, I spoke about the PESTEL analysis, conducting a political, economic, sociocultural, legal, environmental, and technological assessment is very important to identify the opportunities that will come from that environment as well as the threats. So now, with this in mind, you can better identify how you can really use, how can you capitalize more on your strengths to dampen your weaknesses, take advantage of the opportunities, and defend your business from any incoming and unexpected threat. Now, the competitor analysis that you did, as well as the SWOT analysis, should help you now to choose one of those three strategies. How can you really gain a competitive advantage? How can you really show that your business is more powerful than any other business? How shall you stand high and shine? What is going to be your key selling point, or what we call your unique selling point? So some businesses just choose cost leadership. By cost leadership, we're talking about a company or an entrepreneur that says, well, I do not want to aim high. I'm satisfied to produce a very simple version of that product with the minimum of options, with the minimum of features, because I want to reach the market segment of people with low income. This is my strategy, and you have to respect those people with this. But if you really follow this strategy, this targeting strategy, then you cannot sell your product at a high price. So you have to work hard to keep your cost low so that you can sell your product at low price. And this will be your distinctive point. That is going to be your point of differentiation. Some other companies say no. We will aim more high. And that's why we're going to apply the differentiation strategy. With the differentiation strategy, actually, you aim to reach multiple segments and you really want to offer high quality. You want to be really looked by people as being superior, as being distinctive, and that's why you adopt a differentiation strategy. Companies that adopt this strategy to gain a competitive advantage, and this will be the key for their success, well, they will be definitely selling their products at a relatively higher price. What about the blue ocean strategy? The blue ocean strategy is actually a balance between cost leadership and differentiation. For a long time, it has been difficult and even impossible to pursue at the same time cost leadership and differentiation, because we know if you really want to improve the quality, that means there is an extra cost. However, nowadays, some companies succeeded to integrate technology into their productions so that they have reduced their costs, but not at the expense of quality. They were successful using state-of-the-art technology to reduce cost and improve quality at the same time. And that's what we call blue ocean strategy. It's very risky, but if you do it successfully, then its rewards are really great. In light of the market assessment, it's also very important to understand the product life cycle. Well, products move along a cycle. When you develop a new product, it is still new. And that's why you can see from the green figure that sales are zero during the development phase. And your profit in the red curve is negative. You're losing money. And that is normal because you have not yet started to sell, and that's why you will be losing. During the introduction phase, which is the second part, well, you start to produce, you distribute, and that's why the green curve is ascending. And now I can see that the profit curve is also ascending, but is still a loss. However, the situation is getting better. During the growth stage, which is the third stage actually, I can see an exponential growth in the sales figure, in the green figure, and now, fortunately, the profit has become positive. The red curve is now on the positive side and not anymore on the negative side. So I can see a high and an increasing profit level. You reach maturity. Maturity is the fourth column in the graph in which your sales is going to peak. However, it cannot grow anymore because the market has become fully saturated. You reached maturity. You cannot expect your sales to grow any further. You still have a profit. But again, you expect during the maturity phase, you expect more competition, and that's why you have to be very careful how to minimize your cost and how to improve your operational efficiency so that you are not kicked out from the marketplace. If you cannot really make proper product modification and cut some redundant costs, then in that case, you might go into a decline. A decline is a stage in which you suddenly feel that no one and very few are still buying your product, and that's why your sales will go down rapidly, as well as profits. So again here, one possible solution is to do downsizing. Many companies at this level decide to lay off many employees, because this is one way to keep some profit available, to extend as much as possible the life of the business until you probably generate or develop a modified product, and then you can make a returning point on that product life cycle by moving it upward again. Now, what about pricing decisions? Now that we spoke about the product, the second P of our marketing mix, I'm now reflecting on the marketing mix. The first P was the product, and it's very important to understand the product life cycle. The second P is the pricing decision. Well, how shall you treat your prices? Usually, when it comes to newly developed product, there are two pricing decisions. It's either price skimming or price penetration. With price skimming, you decide to introduce this innovation because it's really an innovation. There is no substitute for that. People want to buy it, and that's why you feel safe to introduce it at a very high price, and that's what we call price skimming. On the other side, what is price penetration? Well, you have a new product, but you cannot see that this product is a real innovation. And there are many other substitutes in the marketplace for that product. So if you decide mistakenly to increase the price, people will not buy that product because they have some substitutes. There are alternatives for that, and that's why you choose price penetration. Promotional pricing, it's a reduction in the price during the low season. Odd pricing is more psychological. With odd pricing, you can imagine a pricing situation in which, well, you sell a product at a price of 999 Qatari Riyal, 999 instead of 1,000. So this is psychological. In the mindset of people, in their subconscious, well, they believe that it's only 3 digits, and the 3 digit is somehow cheaper than 4 digit, so they can fall into that trap. So it's a trap, and many people might be victims of that trap, but at the end, you did not cheat, you did not bluff any people. So your price is 999. So now, whether they misunderstood that or misperceived that, then it is definitely their problem. Captive pricing is when you are producing something and you have some waste. Okay, you produce clothing, garments, and you have some textiles. Now, what about the waste that is left? Some pieces of textile are very small. They have some shapes that cannot be used anymore to produce any t-shirt. So what shall you do with that? You can sell them to a cotton manufacturing company because they can use these byproducts as some inferior products for them to make some money out of that. Bundle pricing, it's when you actually put 3 different items together and you sell them as at one price. Many computer shops say, well, you can buy a laptop with a printer, with some accessories, just for 4,000 riyals. So this is an example of bundle pricing because the whole bundle, the whole package costs that much. We come to distribution channels. Again, I already spoke about distribution channels, and we said, well, distribution can be direct. When the producer sells directly to the end user, when you go to the restaurant, this is an example of direct distribution. The food is cooked, the food is prepared directly, and it will be served directly in the same place. Indirect distribution, it's when you buy something from a reseller. How many times you buy packaged salads, for example? In that case, this salad is not produced in the same place, in the same restaurant in which you're gonna sit down and dine in. No, you're buying this salad as a packaged salad from a reseller, but it has been produced by some other companies or some other restaurants. So this is indirect distribution. Digital distribution is distribution through e-commerce, through e-shopping. Omni-channel is, as I said earlier, it's a system that integrates digital and physical together. Now we come to the last item of the marketing mix, which is the promotional mix. Okay, so what to do with the promotion? How shall we advertise? How shall we reach? So we have a wide array of promotional tools that we can use. In your business plan, you need to have a table, a schedule that shows all type of advertising, PR, public relations, publicity, events, sponsoring, activities, programs, as well as social media campaigns, website optimization, search engine optimization, website development, okay, bloggers and blogging, okay, microblogging is done through Twitter, and you have some major blogging, so you should really take advantage of all those, okay, marketing communication channels. And that's why when you integrate offline and online together, that's what we refer to as integrated marketing communications. Now we come to the fourth section. In the fourth section, we need to discuss the operational planning that we need to do. What organizational structure? Well, marketing is great, but this should be supported by a good organizational structure. That starts with a proper job analysis. When we do a job analysis, then we can understand what the jobs we have created so far and what are the job qualifications needed, skills and competencies that people should possess for them to apply for such jobs. And this is how we start our recruitment. In addition to identifying jobs by doing the job analysis, we should be working on business process management, what we call BPM. Everything in a company requires some process. Operations and manufacturing has to go through a process, a step-by-step approach. Customer orders should go through a process. What best process you need to design to make this experience really good? All of that should be explained in your business plan. When you explain it, well, you appear more professional and knowledgeable. In addition to that, you have to have a good organizational structure. The organizational structure is the department. It includes all departments that you have created so far for the purpose of better serving your internal clients, i.e., I mean the employees, as well as your external clients. The good thing is you have to have the best mix between your organizational structure and the business process management tool that you have used for the purpose of creating efficient and effective business processes. Within the operations, you also need to think about safety and quality. How shall you really achieve the highest level of safety and quality standards? You have to be fully aware of regulations. Any industry that you choose, food, it is regulated by the FDA. Okay, clothing, it has some regulatory bodies. Okay, finance, you have the central bank, that is the regulatory body. So there are always regulations, and you have to be very smart. In your business plan, again, you have to show the measures you are taking and that you intend to take so that you appear fully aware of the regulations, and what measures are you taking so that you are not against the law. You are not against those regulations when it comes to the practices, the norms. What about total quality management, TQM? Again, this is very important. What are the measures? What are you doing? We know very well that total quality management necessitates a strategy that shows continuous improvement, using something called like Six Sigma, okay? Taking care of all the possible errors, all the possible deviations, so you should be fully aware of that so that you can manage all of that. ISO is a quality certification institute or agency that is located in Switzerland. It stands for the International Standardization Organization. Well, and there are many other accreditation agencies. It's very important to get a leverage, to get some sort of co-branding and a leverage. The moment you say that your brand or your products are accredited by ISO and that your employees have undertaken a full program on Six Sigma and total quality, again, that appears to be a one step forward towards success. Again, one thing about operations that you have to be aware of is the sourcing. From where are you gonna buy your materials? You have to identify the most appropriate suppliers. Who are they? So again, now in a globalized economy, well, we are governed by 4 Ps. The volatility, things are changing very, very fast. The speed of change is very fast. Every day there are thousands of suppliers that shut down and millions of suppliers that open all over the world. Velocity, that's the speed, okay, of this volatility, of that change. Variety, well, the wide area of suppliers have different types of raw material. from specifications to quality level to everything. So the exercise of conducting due diligence and evaluating the most acceptable vendors or suppliers is becoming more challenging. Again, there is no consistency in quality, so among most of those vendors. So again, you have to search for the best vendor, for the best supplier, at least not to have variability, to eliminate any sort of variability and make sure that what you buy is always standard. So that's why the moment you find those good suppliers, think about a win-win long-term relation. I spoke earlier about the SRM, supplier relationship management. That is quite similar to CRM, customer relationship management. So equally likely, if you really want to build good relations with customers, again, this should necessitate as well building good relations with suppliers as well. We come to personnel, recruitment. Again, nowadays, you can recruit from all over the world, as I said earlier, but provided you have a plan, provided you did a job analysis and you know exactly what job vacancies you have. If you already filled in some job vacancies, you should always think about succession. What if some of those employees leave suddenly? So that person gets another offer from another employer. Then in that case, you should not really keep yourself under cover. You have to have a cover, at least a partial cover. Other employees in the company should have been given some training, at least to take part of that responsibility until you replace that person with another employee. So you have to have a good plan for your employees, for the way you're gonna recruit employees. How shall you find those talents? What shall you offer to attract them? What is the service that you're gonna give so that you retain them and then you keep them working with you for a longer period rather than leaving you for other employers? So all of these questions are very important to be raised. Now, again, if we have to think about financials now, and before we move to the fifth section of that webinar, it's very important to talk about the importance of doing a sales forecast. I cannot build up any financial forecast unless I have a vision and I can properly estimate the volume of sales. So there are many techniques here for doing the sales forecast. Some of them are quantitative, relying on regression analysis, statistics, moving averages, market surveys, market tests, and market share analysis as well. At the same time, especially for newly developed product, we don't have history to run regression. We don't have history from previous sales to do a moving average. For new products, well, you have to rely on qualitative techniques like meeting with experts. That's what we call the Delphi technique. Okay, getting some input from the sales force, because the salespeople know the market very well. They have experience in the marketplace so that they can really help you. You can have a group of customers who are very loyal to your company. You can arrange a group meeting with those customers that are known as the customer advisory board so that you get their opinion about how much they intend to buy this new product if once available in the marketplace. And this is how you can actually make a forecast about the future. You can generalize what you get, what you hear from small samples to larger samples. Now, the moment you finish with your sales forecast, now you can do a better revenue budget, because your sales forecast is actually your revenue side, and you can also identify your expenses, because your expenses that are based on the matching principle, you match them against the revenues. Again, that is very, very important. If you haven't done the sales forecast, you cannot really generate any revenue budget or any expense budget. The fifth section of this webinar is the financial analysis. For sure, I'm gonna try to simplify this part, because this part can be a course, can be another webinar. And by the way, each section of this business plan, Section 1, Section 2, Section 3, Section 4, and now Section 5, each one of them can be extended to become later on a course by itself. So the fifth section is about the financial analysis. One good way is to use Excel. Excel is really great because through Excel, you can make several scenarios. You can use the built-in functions in Excel so that you put your revenue budget. As you can see on the upper left side, we have the revenues, and then we try to identify the cost of goods sold. What will be the cost of producing such goods so that we know what our gross profit is. The gross profit is never your profit because you have to deduct from the gross profit whatever selling expenses you have, salaries, research and development, depreciation of machinery and equipment, the maintenance and repairs you have to make. So all of that is a list, and this will accrue to a certain amount. And now if you have some loans to the bank and probably other creditors, you have to pay interest, and with this you are left with a certain taxable income. As you see under the year 2018, that is somehow equal to 15,000. Okay, the amount of tax is 15,000. This will make your total expenses this much. So you have this much expenses, you have this gross profit. What will be your net income? Your net income is going to be the difference between your gross profit, 157, and your total expenses, 64. That is your net income actually for year 2018. What do we call that? That's what we call a forecasted income statement. Through the sales forecast that we did earlier, we should have really succeeded to make this forecasted income statement. The second type of financial statement that you have to present in your business plan, that is very important because this is where the readers are gonna really open their eyes big and they have to go into the numbers. They will be crunching the numbers from your forecasted income statement and now from your forecasted balance sheet. The balance sheet is a financial statement that shows what the company owns. What do you own? What are your assets? From current assets to long-term assets or fixed assets, what we call property, plant, and equipment. And then you have the liabilities. The liabilities are the debts. What do you owe others? Do you owe suppliers some money? You probably have purchased supplies you have not yet paid. You got some loans from the bank and you still have to pay back this loan with the interest. So all of that is under liabilities. Now, to make sure that your balance sheet is correct, total assets should be always equal to the sum of total liabilities and stockholders' equity. Stockholders' equity reflect the capital of the owners. You as an owner, the other partners who brought capital, who brought funds to the company, and people who bought probably your shares, your common stock or your preferred stock, are all there here in this section. All the money appears here under stockholders' equity. We come to the forecasted cash flow statement. This is also very important. This statement is very important so that any financial analyst later on who's going to analyze your numbers will see that year after year the company will have enough positive cash to pay its debts. If a company year after year does not have good amount of cash for liquidity, then that company is going to fail for sure in paying back its debts, in paying back the interest. So for that reason, preparing a cash flow statement is a must in your business plan so that you show the bank and you show the investors that year after year you have enough cash to pay them what you owe. You owe them interest, you owe them part of the loan, or you owe them some profit share in case we're talking about venture capital. Here actually we can see the sources of financing. In addition to preparing or to showing in your business plan the three set of financial statements, forecasted income statement, forecasted balance sheets, and cash flow, forecasted cash flow, now you have to show the bank and you have to show the other community, okay, what are you planning? What are you planning? How are you planning to get the money? How will you get the money to start that business? Are you gonna get it from your own money, family? Angel investing means saying or finding an investor who believes in your business because it has proved after probably a few months that that business is good. So you bring some investment and we call it angel investing. Later on, probably 2 years after, the company grows even more and more. Not only one investor is willing to put his angel money into this business. Then you will succeed with that to bring more money, more funds from other investors, and that's what we call venture capital, as I said. Debt financing is the money you get from the bank or from any other company, financial institution that is willing to lend you money. So they are not being partners, they are just lending their money. Now, again, in your financials, it's not enough to show the results of your income statement, your balance sheet, your cash flow. It's also important to apply some capital budgeting techniques. You need to prepare a free cash flow table. Again, that is a course by itself that requires 1 hour at least of explanation. And then within that table of free cash flow, you should be capable to identify, to calculate the net present value. You have to show the bank, you have to show the investor that the expected net present value from this business is positive. You have to show that the internal rate of return, which is somehow, if you want, a proxy for the return on investment, you have to show them that this IRR, or return on investment, is much higher than the cost of capital, what we call the WACC, the weighted average cost of capital. And you have to show a profitability index that is greater than 1, so that the net value of positive cash flow is greater than the net value of negative cash flow. So you put them in a ratio. And in that case, it has to exceed 1, so that we show that positive cash flows are greater than negative cash flow. The payback period is the number of years you need to wait until you recover the amount of capital. If you invested in this business as a startup, 3 million riyals, how many years you have to wait until you collect that money back, until you recover this capital? Okay, so that is what we call the payback. For sure, the shorter the payback period, the better. For the bank, the better for the investor. Again, as I said, for you to calculate the net present value, for you to calculate the IRR, for you to calculate the profitability index, you need to have a free cash flow analysis. The free cash flow analysis is a table that starts with listing the initial investment needed, what additional investment in net working capital for the yearly or for the quarterly financing that you need, what are your cash revenues, what are your cash expenses, what will be your net operating profit after tax, what is going to be your operating cash flow, and finally, what will be your free cash flow. This is a calculation that you have to make for all the years. From the first year you start that business, we refer to it as year 0, and then you have to have at least a planning period, a financial planning period for 7 up to 10 years for you to do a good FCF analysis. Now, the last section of this webinar, and we finish everything, is about performance measurement and risk management. For sure, the daily activities that you're going to undertake, the implementation of this business plan has to be monitored. You have to control it. And that's why you need to have some key performance indicators. A KPI is a benchmark, is a measurable target. So you put a measure, and then against that measure, well, you say whether you are, or you conclude whether you achieve what you intend to achieve or not. So among those KPIs, you can include website traffic. You probably say, well, I want to see every day not less than 1,000 people who visit my website. Then this measure becomes a KPI. The conversion rate, how many people who visit your website are going to convert to an ad or convert to a purchasing cart or a shopping cart? Then again, you say, well, I want my conversion rate not to be less than 3%. So that is a yardstick. That is a measure that you put. You decide about those measures based on your experience. What about the churn or loss rate? This is another KPI. Well, if you already attract customers, you have to make sure that the big majority of them stay your customers for the second year, for the third year, and they rebuy and rebuy and they rebuy, so that they are always loyal and loyal. So this is very, very important. So all of these are KPIs, and usually what we do, all companies should have a software. There are many software development companies that provide such a dashboard. A dashboard is a real-time dashboard that shows those KPIs, how they are moving. So, for instance, when I said earlier, if you decide that the conversion rate should not be less than 3%, so every time the conversion rate goes below 3%, the dashboard for that metric becomes red. Why? So that you can see it. It becomes a red flag. There is a problem here. So you don't have to wait until the end of the month to see those figures, because nowadays through business intelligence, BI, through business intelligence, such a dashboard has become dynamic and real time. You can see exactly on momentum basis what's going on vis-a-vis every KPI you determined. So if performance exceeds the benchmark, then it's green, it's perfect. If performance is revolving around the benchmark, then it's yellow. If performance is below the acceptable benchmark, then it becomes a red flag. What about risk management? What about risk mitigation? Every company is surrounded by many risk factors. So a wise business plan has to show exactly what are the possible sources of risk. You need to identify those risks. You have to have a risk register and do proper documentation. And then once you identify the risks, you cannot just watch the risk. You have to take action. You have to do a risk analysis. You have to measure how much that risk is big. You need to quantify that risk so that you make a good evaluation of the risk, so that you check its impact, whether it has a high or low impact, a high probability to occur or a low probability. For sure, a risk with a low probability, as if it does not exist, so you can ignore it. A risk with high impact or high probability has more pain, and that's why you need to transfer that risk or hedge that risk. So probability, it's the degree of its occurrence that can be low or high, and impact, it's whether it is severe. Are the damages going to be high from that risk or minimal? So it is low and high, low severity, high severity. That's the impact. So I always take, so if you have any risk and you consider that risk to have low probability of occurrence and low impact or low severity, you can ignore it. If there is a risk with high probability and low impact, well, you can hedge by making some investments in financial derivatives. That is also a subject we can discuss thoroughly if we have other webinars in the future. If you have a low probability and a high impact, you can transfer that by buying risk insurance. So again, you have to be fully aware of all types of those risks. With this, I hope you enjoyed this webinar, and if you have any questions or for more information about the professional training programs offered by the Continuing and Professional Education Directorate of UDST, please contact the CPE team through the email or phone number provided here. Thank you a lot.